Hello everybody, welcome to today's episode of the Daily Dose. Today is Tuesday, December 6th. We saw the stock market kind of continue its sell-off from yesterday. The S&P 500 was down 1.4%, the Dow Jones was down 1%, and the NASDAQ was down 2%. So Wall Street failed to recover from a rout in Monday's session when stocks sunk while investors poured over the first releases in a full week of economic data. Overall, the S&P 500 had its sixth down day in the last 7 trading sessions. On Tuesday, the biggest Wall Street bank executives struck a downbeat tone for next year as inflation hits consumer demand. Bank of America CEO Brian Moynihan told investors at a Goldman Sachs financial conference that Bank of America's research shows negative growth in the first part of 2023, but he added that the contraction will be mild. Goldman Sachs CEO told Bloomberg that he sees economic growth slowing and smaller bonuses and even possible job cuts on the horizon. Economic data readings have pointed to continued resilience in different pockets of the economy. However, prompting intense market fixation around the risks that the Federal Reserve will continue to raise interest rates throughout next year. Fed officials, including Chair Jerome Powell, have largely suggested the central bank will downshift to a half point at their next meeting next week after 4 consecutive 75 basis point increases. But last week's employment report showed strong job gains and robust wage growth, the opposite of what the Fed would like to see in its battle against inflation. A smaller increase would dictate a new phase for the central bank's tightening campaign, but elevated wage pressures could lead to more officials raising their benchmark federal funds rate above 5% next year. So 50 basis points is not for sure, 5% as the terminal rate is not for sure, and I think the market will get slammed if we get another 75 basis point rate hike. I think the entire rally we got was based off the fact that they're finally going to wind down the rate at which they're raising the interest rates. And I think if the terminal rate or the expected terminal rate ends up going above 5%, I think that would also contribute to the fall in stocks. Obviously, we knew that this trend line would be a big indicator. We knew that the 200-day moving average would also be a big indicator, but the S&P 500 ended up moving above the 200-day moving average, but did not make it above the trend line that we have drawn out on the chart here. So if you take a look, the price action actually came up exactly to the trend line and ended up bouncing back down, which creates even more conviction and confidence in the levels that we have drawn out. But it also could lead to another leg down in the stock market. And it also could lead to lower lows, and we may not have necessarily hit the bottom of this market yet. And personally, I'm still eyeing a level around the 3250 on the S&P 500 as a potential place for this market to go next. As for Bitcoin, still kind of consolidating, but looking a little bit weaker. We're still underneath that range. Obviously, right now we're just under 17,000 at time of recording, but it does look like it's going to continue down, and I'm looking anywhere between 10,000 and 12,000 for the next place for Bitcoin to kind of either settle or make a bottom at. So that's what I'm looking at in the markets. Nothing crazy today, obviously. We're kind of falling over on the stock market, and that could bleed over into the crypto markets. There's a lot of conflicting data out there. Obviously, the Fed kind of hinted at maybe the 75 basis point hikes are over, and maybe that's true. Maybe they'll still go 50, but maybe they'll still push that terminal rate higher, and maybe it'll have to stay there for longer than expected. So we're definitely not out of the woods yet on the market. Usually, the stock market doesn't even bottom until 2 months after the Fed stops. Usually the stock market doesn't bottom until 2 months after the Fed starts cutting rates. and we're not even close to the end of the rate hikes. So I do think that there definitely could be some more pain in this markets. There was a little bit too much bullishness for me. Everybody wanted to get into stocks as they were on the rise, and now they're coming back down. So it was to be expected, and I think we could definitely still see some more selling pressure. I think we're still a little bit elevated here on the stock market, and we definitely could come back down a little bit more. So that's what I'm looking at. Hope everyone had a great day. I do appreciate everyone watching or listening to this episode, and I will see you tomorrow.